June 2019, two financial professionals, same city, same income bracket, both earning approximately $180,000 per year. Person A kept $250,000 in cash savings. High yield account. 2.1% annual return. Safe. Predictable. The numbers made sense on paper. Person B took $250,000 and mirrored central bank reserve positions. 40% into physical gold at $1,390 per ounce. 30% into a basket of foreign currencies weighted toward the Swiss franc and Singapore dollar. 20% into inflation-protected securities from multiple sovereigns. 10% into IMF Special Drawing Rights exposure through specialized instruments. Fast forward to December 2023. Person A's account, $271,312. A gain of 8.5% over 4.5 years. But here's what the statement didn't show. Cumulative inflation during that period was 23.7%. Real purchasing power of that cash? Down to $207,000 in 2019 dollars. An actual loss of $43,000. Person B's position, $387,600. Gold alone sat at $2,071 per ounce. The franc appreciated 6.8% against the dollar. The SDR basket gained 4.2%. Total real return after inflation, 55%. Same starting point, same time period. Different outcome. What happened here was not luck. Person B didn't have insider information. They didn't predict COVID-19. They didn't time the market. What they did was simple. They watched what central banks do, not what they say. Because while your savings account offered you 2%, the institutions that control your currency were moving billions into assets that directly contradict the advice they give you. I call it the reserve divergence protocol. It's the systematic difference between what monetary authorities hold to preserve their wealth and what they encourage citizens to hold. It's not a conspiracy. It's not hidden. It's published in quarterly reports, IMF data sheets, and central bank balance statements, but almost no one reads them. The mechanism works like this. When a central bank expands its money supply through quantitative easing, emergency lending, or direct monetary creation, they simultaneously shift their own reserve composition away from the very currency they're creating. They dilute the supply. Then they exit the exposure. You see the pattern once, you see it everywhere. And once you understand the 5 specific assets they migrate toward, you understand something most financial advisors never mention. The people who control your money don't trust it the way they tell you to trust it. Phase 1, the accumulation quiet period. This is where central banks begin increasing reserve positions and non-monetary assets while official inflation remains low. To the public, everything appears stable. Interest rates are manageable. Consumer prices show modest increases, typically 1.5% to 2.5% annually. But in the background, net gold purchases start climbing. In 2010, central banks collectively bought 77 tons of gold. Modest, almost unnoticeable. By 2018, that number hit 656 tons. By 2022 to 1,136 tons. The largest annual purchase in 55 years. This wasn't random. This was systematic repositioning ahead of what they could see in their own balance sheets. Unsustainable monetary expansion. The cause. Monetary policymakers know the numbers before publication. They see M2 supply growth. They see real inflation in commodity contracts and wholesale prices 6 to 9 months before it reaches consumer levels. The effect. They move first. Not because they're corrupt, but because they're protecting sovereign reserves from the very policies they're implementing. Phase 2. Foreign reserve diversification. Simultaneously, central banks shift the composition of their foreign exchange reserves. From 2000 to 2023, the US dollar's share of global central bank reserves fell from 71% to 58%. That's a 13 percentage point decline, representing roughly $2.3 trillion in repositioned assets. Where did it go? The Chinese yuan share rose from 1.1% to 2.7%. The euro held steady at around 20%. But the interesting movement happened in smaller, structurally sound currencies. The Australian dollar, Canadian dollar, Swedish krona, and especially the Swiss franc. Why these currencies? They represent economies with lower debt to GDP ratios, stronger rule of law for property rights, less political incentive for monetary expansion, historical track records of monetary restraint. Central banks weren't chasing yield. They were chasing stability, the exact stability they were undermining in their own currencies. The human behavior component. When you control the printing press, you know exactly how much you're printing. You know the consequences, and you plan accordingly. Phase 3, strategic commodity positions. Here's where it gets less visible but more important. Central banks don't just hold currencies in gold. They hold claim rights to physical commodities through specialized instruments. The Bank of Japan holds positions in strategic metal reserves. The People's Bank of China has systematically built stockpiles of copper, rare earth elements, and crude oil through state-linked entities. Between 2008 and 2023, China's Strategic Petroleum Reserve grew from 102 million barrels to over 1 billion barrels. That's nearly 10 times the growth rate of their GDP. Why? Because commodities have a unique property. Their value is independent of any single currency. A barrel of oil has utility value. A ton of copper has industrial demand. These assets can't be printed, can't be quantitatively eased, can't be politically diluted. The mechanism. When fiat currency loses purchasing power, commodity prices rise in nominal terms but remain stable in real terms. Central banks understand this better than anyone because they cause the phenomenon. Phase 4. IMF Special Drawing Rights and Supranational Claims. This is the most sophisticated layer. Special drawing rights, SDRs, function as an international reserve asset created by the International Monetary Fund. They're not a currency. They're a claim on a basket of currencies: the dollar, euro, yuan, yen, and pound sterling. Between 2016 and 2021, total SDR allocations increased by 660%, from 204 billion to 660 billion SDRs. The largest expansion since the 1970s. Why does this matter? Because SDRs represent diversification one level above any single currency. If the dollar weakens, the SDR adjusts. If the euro falls, the basket compensates. It's structural hedging at the sovereign level. Central banks increase their SDR positions not because they distrust the dollar specifically. They distrust concentration in any single monetary unit, including their own. The cause-effect chain. Print your own currency, right arrow. Recognize systemic risk and single currency exposure, right arrow. Move reserves into multi-currency instruments that automatically rebalance. Phase 5. Real asset claims through sovereign wealth structures. The final phase involves moving beyond financial instruments entirely. Norway's government pension fund, essentially an extended central bank reserve, holds $1.4 trillion in real assets. Equities in companies that own physical infrastructure, real estate in major global cities. Direct ownership stakes in energy production. The China Investment Corporation, the Abu Dhabi Investment Authority, the Kuwait Investment Authority, these aren't separate from central banking strategy. They're extensions of it. Singapore's Temasek Holdings and GIC manage $1.1 trillion in combined assets. These include direct ownership of ports, telecom infrastructure, water utilities, and agricultural land across 4 continents. What are these? They're conversions of fiat currency reserves into physical, productive assets before the currency depreciates. The human behavior insight. If you knew your money would buy less tomorrow, you'd convert it into something real today. Central banks do this at a trillion-dollar scale. Phase 6, the exit velocity moment. This is the phase most people never see coming. It happens when central banks accelerate all 5 strategies simultaneously. Gold purchases spike. Foreign reserve rebalancing intensifies. Commodity stockpiling becomes urgent. SDR allocations expand rapidly. Sovereign wealth funds deploy cash at unprecedented rates. This occurred in 2008. It occurred in 2020, and the data suggests it's occurring right now. Why? Because this is the moment when monetary authorities realize they've exceeded the point of policy reversal. They can't raise rates enough to contain inflation without triggering systemic collapse. They can't continue printing without destroying currency credibility. So they do both and protect their reserves accordingly. 1929 to 1933, the gold precedent. Before the Great Depression, the U.S. operated on a gold standard. But here's what most people don't know. While citizens were legally required to redeem dollars for gold at a fixed rate, the Federal Reserve was simultaneously reducing its gold reserves relative to outstanding currency. By 1933, the gold coverage ratio had fallen to 40%. The government response? Executive Order 6102. Mandatory gold confiscation from citizens at $20.67 per ounce, followed immediately by a revaluation to $35 per ounce. The government and central bank increased their gold position by 69% overnight. Citizens who held dollars lost 41% of their purchasing power in terms of gold. The pattern. Expand currency supply right arrow, protect institutional reserves right arrow transfer value from public holdings to sovereign holdings. 1971, the Nixon Shock Framework. August 15, 1971. President Nixon closes the gold window. No more dollar to gold convertibility for foreign central banks. What happened in the 2 years prior? Foreign central banks, particularly France and Germany, had been aggressively converting dollar reserves into gold. France alone redeemed $3.5 billion in a single year. Why? Because they could see U.S. monetary expansion outpacing gold reserves. They were central banks watching another central bank. They knew what was coming, the outcome. Countries that converted to gold before August 1971 preserved value. Countries that held dollar reserves saw a 24% devaluation within 18 months as the Smithsonian Agreement reset exchange rates. 2008, the Great Financial Crisis Rehearsal. In 2007, before the public understood the scale of the crisis, central banks began coordinating currency swap lines and expanding balance sheets. What else were they doing? Buying gold. 2007, net central bank gold sales of 400 tons. 2008, net purchases of 200 tons. 2009, net purchases of 400 tons. This was a complete reversal of a 20-year trend. For 2 decades, central banks had been net sellers of gold. The moment their own policies required unlimited monetary expansion, they became net buyers. The Russian central bank increased reserves from 12.4 million ounces in 2007 to 73.9 million ounces by 2020. That's a 495% increase during the exact period the ruble faced maximum devaluation pressure. The message was clear. Protect sovereign reserves while the public absorbs the inflation. 2020 to 2023, the pandemic acceleration. March 2020, the Federal Reserve expands its balance sheet by $3 trillion in 3 months. The largest monetary expansion in U.S. history. Simultaneously, global central bank gold purchases in 2020 to 273 tons, 2021 to 463 tons, 2022 to 1,136 tons. The People's Bank of China didn't report gold purchases from 2016 to 2019, then suddenly announced reserves had increased by 100 tons, then reported monthly additions of 15 to 30 tons consistently through 2023. The European Central Bank expanded its balance sheet by 4.7 trillion euros while quietly increasing its gold reserves from 10,788 tons to 10,962 tons. The pattern held. Print currency, right arrow, accumulate hard assets. The common thread. In every crisis, the same sequence. 1. Monetary expansion accelerates. 2. Central bank reserve diversification accelerates. 3. Public holdings lose purchasing power. 4. Sovereign holdings preserve or gain value. It's not malice. It's structural logic. When you create the currency, you understand its future value better than anyone, and you plan accordingly. Right now, we are in phase 6. The data is clear. As of Q4 2023, global central banks have purchased 2,952 tons of gold in the past 3 years. That's the highest 3-year accumulation since 1967. The dollar's share of global reserves continues declining, from 61% in 2020 to 58% in 2023. That's a $700 billion repositioning in just 3 years. China's foreign exchange reserves have become increasingly opaque, with official numbers showing stability at $3.2 trillion, while independent analysis suggests a compositional shift away from U.S. treasuries toward gold, commodities, and hard assets. The Swiss National Bank, traditionally one of the most conservative institutions in global finance, maintained gold as 6.4% of total reserves, even as they expanded their balance sheet by 400%. They bought gold proportionally to their currency creation. We're also seeing something unprecedented. Smaller central banks joining the pattern. Poland increased gold reserves by 100% since 2018. Serbia bought gold for the first time in a decade. India added 200 tons in 2 years. This isn't coordinated. This is convergence around the same structural realization. Fiat currency exposure is becoming too concentrated, too risky. The acceleration before the recognition. The institutional moves happen first. The public awareness happens later, usually after the value transfer is complete. If you want to track this in real time, watch 4 specific indicators. Signal 1, the gold purchase rate of change. Don't watch total reserves. Watch the quarterly acceleration rate. When central banks go from buying 200 tons per quarter to 400 tons per quarter, that's preparation. Signal 2, the dollar reserve share decline rate. The IMF publishes COFR data quarterly. Watch the year-over-year change in dollar percentage. A decline of 1.5% or more per year is a structural shift. We are currently at 2.1% as of Q3 2023. Signal 3, Sovereign Wealth Fund Deployment Speed. Track the capital deployment rate of major funds like Norway's GPFG. Norway's fund went from deploying $40 billion per year in 2019 to $73 billion in 2022. That's an 82% increase in converting liquid reserves into physical claims. Signal 4, IMF SDR allocation announcements. These are significant. An SDR allocation means the global monetary system is acknowledging that single currency reserves are insufficient. The 2021 allocation of $650 billion was the largest in history. Let's go back to June 2019. Person A and Person B, both intelligent, both informed, both had access to the same information. The difference wasn't intelligence. It was framework. Person A followed conventional advice. Keep cash liquid, earn interest, stay safe. That advice came from institutions whose own behavior contradicted it. Person B followed institutional behavior. Diversify into what central banks actually hold, not what they recommend. By December 2023, Person A had experienced a real loss of $43,000. Not because they made a bad decision in the traditional sense. They made the decision they were supposed to make. Person B gained $137,600 in real terms. Not because they were smarter, because they aligned with revealed behavior rather than stated guidance. Same economic environment, same inflation, same monetary policy, different framework, different outcome. The question isn't whether this will continue. The data from 1929, 1971, 2008, and 2020 shows this is a structural pattern, not an anomaly. The question is, which framework are you operating within? Central banks aren't your enemy. They're operating within structural incentives that prioritize sovereign stability over individual purchasing power. But understanding this creates a choice. You can hold the assets they tell you to hold, cash, bonds, conventional savings, and accept the systematic transfer of purchasing power. Or you can hold the assets they actually hold, gold, foreign currency baskets, commodity-linked instruments, real asset claims, and supranational reserve instruments. The Reserve Divergence Protocol isn't new. It's not secret. It's published. The data is public. The pattern is clear. The decision is yours.